Welcome back. You're watching Stock Watch with me, Zinati Kuma, and joining me to take your stock-related questions tonight are Graeme Körner from Körner Perspective and Mark from Oyster Catcher Investments. Be sure to send your questions on email at stockwatch@bdtv.co.za or via SMS on 41392 or on X using the hashtag StockWatch. Thanks for your time, gents. Let's get to the questions because there are lots. And I want to start off with Sassel so that we get it out of the way now. And people don't say that we forgot about it or we don't ask the questions. When can we expect the share? Oh, wait. Is this it? Please ask the panel, when we can expect the share to rally. Surely it has bottomed out by now. And that is really the million-dollar question because right now it is at just under 93 Rand. But I mean, the same questions have been asked when it was 94 Rand, when it was 97, when it was 102. There's no easy answer to this, Mark, is there?
Yeah, I mean, I guess the question is, what are you basing your view on? If you're looking at the previous share price, it's not a great predictor of the future share price. So just because Sassel once traded at 400 Rand a share, not too long ago actually, doesn't mean that it's worth that now. I mean, certain things have changed for Sassel, which is not in their favor. So recently, Treasury put out a discussion paper on the carbon tax, which was slightly more negative than what some people thought the final proposal would be. So which means potentially Sassel is going to be paying out 4 billion Rand a year in carbon taxes to Treasury, which is obviously not great for a company that needs a lot of capex to be reinvested in their business. So that was a recent negative. But I think more broadly than that, the problem is, well, number one, the other one is the outlook for oil. So there's a lot more bearish outlook for oil now that Trump has been elected president of the US. And I mean, one of his slogans is drill, baby, drill, speaking about how he wants the US to continue ramping up exporting of oil into the market. That negative for oil prices, globally, the shift towards more battery electric vehicles, also negative for oil price. So I think the outlook for the oil price has changed a bit, slightly more negative. And then the other big product for Sassel is chemicals. So they bought their big Lake Charles plant, and it's come online now. They are a low-cost producer, and they should be able to maintain that plant and make reasonable money from it. But because chemical prices are subdued, they're not making the margins that they thought they would at this point. And again, the outlook for the chemical prices seems quite, it's not exciting at this point. There's more capacity coming on in China, and we know that in China they like to build overcapacity. So the outlook for chemical prices in the medium term is also poor. So you add all that together, and there's no real reason to buy Sassel at this point. For me, I would buy Sassel when I see chemical prices start to turn up, or I mean, if you think that the oil price is about to start racing up.
Yeah, very interesting point that you make there, Mark, that things are not the same now as they were when Sassel was at 400 Rand per share. On your side, Graeme, I mean, we spoke off air that people ask about Sassel every day, hoping that somebody is going to change their mind. I think actually, if I look back, I think the only person that was really bullish on Sassel was Wayne McCurry. I actually don't know where he stands right now, but he has also noted that sometimes he has been wrong. Graeme, your thoughts on Sassel, and if maybe and that's the thing, because people also ask, because they try to gauge if maybe they should get in before the tide starts turning. As Mark says that he wants to wait until the tide does turn. What would your feeling be here?
Well, firstly, I would agree with Wayne. We all make mistakes. Some of us make more than our fair share. But yeah, I mean, Sassel was a massive holding in some of the most highly rated value manager portfolios, even quite recently. So I think a lot of people were buying, I suppose, in a way, the history of Sassel. I think Mark unpacked it beautifully, that if you look at the forecasts, I was looking at them a second ago, 38 Rand's worth of earnings for this current year, and then 48. I mean, you're talking about, 3, 4 P's, not even 3 PEs. It's ridiculously cheap on that. But I think everything Mark spoke to is right, that unfortunately, the sands are shifting beneath their feet. So the business model that used to deliver 45 rands worth of earnings or 50 rands worth of earnings has changed. I think on the short term, Mark's absolutely right. I think the drill baby drill hypothesis is definitely throwing a little bit of cold water on oil. But if you look at polyethylene prices, for example, they may be up from their lows in 2020, but they really just drifting sideways. So as Mark said, that project came online not only at the worst point in the cycle, but as other capacity elsewhere around the globe was coming online. So I've always said that the carbon tax, given the fact that they are a massive emitter, has to eventually come. They talk a lot about transformation of the business model, but how do you replace syn fuel, petrol or diesel from coal or gas? How do you transform these businesses meaningfully? So I think the bottom line is I mean, it's crazy to think if you'd asked anybody this 5 years ago, we would have kind of said, yeah, it's relatively predictable. It goes with the rand oil price and so on. But it's become, I hate to say it, it's become a punter stock because I think the risk that the carbon tax introduces, has the risk of significantly deflating whatever earnings they're generating out of the core fuels and plastics business. So, like everybody, I suppose we're waiting for this incredible rally up to 200 where we can all exit. But, the market is telling a different story. So, anybody who's saying, is this thing about to take off? Oil price could rocket, could be a few things that drive it, but on fundamentals, I think Mark hit the nail on the head. This thing has become very, very unpredictable, and probably you want to miss out on the first 20 or 30 rand and then have a little bit more visibility. But it feels to me very, very unpredictable, and I think both Mark and I don't like those investment stories.
Well, let's talk about an investment story that seems to have taken off, and that is for Boxer. I do know that, Mark, Boxer is your stock pick for later on. But, I mean, just maybe a comment on, so there's a comment from a viewer. 50 years, Sean Summers Jr., and I kind of get when Shapiro said he is a retailer, a proper retailer. The structure of the deal, and with Pick n Pay maintaining a controlling a stake, what do you actually think of the structure of the deal? The fact that Pick n Pay is still maintaining 2/3 of Boxer?
Yeah, I mean, I think it's smart. So, I mean, we know that Pick n Pay's been going through quite a long restructuring process over a number of years. I mean, their cost base just got too high, and a number of CEOs have come and gone now and tried to right the cost base. So Sean Summers is here again to try right the cost base and to get that margin up. I mean, Pick n Pay sells, I think it's a 2% sales margin, whereas Shoprite's 5%. So the bull case is always that Pick n Pay can get their margins up, but they just haven't been able to do that. And they don't have the distribution scale that Shoprite does, and they don't have the 60/60 type. I mean, they have their own, but it's not as good. So they've been struggling. So I think the idea to list Boxer separately, I mean, Boxer is a great growth story, and it was not being valued properly by the market within Pick n Pay. And on the listing, Pick n Pay also raised 8.5 billion rand, and now that money can be used to reinvest in Pick n Pay and to right the ship. But I think that therein kind of lies the difference in the two investment stories. One, Boxer, you're investing in a growth stock. They're going to double the number of stores over the next 5 years. It's going to be a fantastic growth story. Whereas Pick n Pay is a fix-it story, and it's going to be consuming that cash that's raised now to try and fix a business, which is a more difficult proposition.
All right. Well, it is listing on the JSE on Thursday. Graeme, do you think, here's a question, do you think us retail investors will get our hands on Boxer stocks on the JSE? And if we are lucky, will 60 Rand be a good buy?
Yeah, so I think obviously that part of the market, that segment of the market has definitely captured the attention. I mean, Mark can talk more to it, but I think it was right up at the upper end of the guidance. They seem to put it away quite easily. I think what Mark also said is very, very powerful, and that is, it's not as though, Boxer has an open goal and that ShopRite are going to roll over and play dead. They compete head on, and they are very, very good operators. So I think it's great that Boxer kind of flies solo. I think it's brilliant that Pick n Pay retained the slug that they did, because the other good thing is that although they've liberated some cash, they can now say to lenders, yeah, but look, our balance sheet has got this incredible asset that's listed, and we could put stock away reasonably easy. So I think it's changed the relationship that they'll have with lenders on a variety of levels. But I personally would wait. I think they've captured the imagination. They're in the right segment of the market. I mean, I was looking earlier today, if you take a company like ShopRite, which we think is a brilliant business, but the multiple looks a little bit cuckoo to me. You've got a multiple of 25 times for a business that I think, even though it's brilliant, it's not like they're going to grow their profits by 15-20% a year for the next 5 years. It might be a 12% or something like that. So I think the problem is that the market is probably looking to that kind of rating and saying, well, Boxer's a very good operator, and it could be, independent, it could be liberated more. But my point is that they've got some very, very stiff competition, not just in ShopRite, but obviously elsewhere in that space. So I personally would wait and just see how it plays out, and maybe get 1 or 2 results under the belt before I make a call.
Well, as we're talking about high valuations, we know that Capitec is also in that grouping. There's a very interesting question here on We Buy Cars. It asks, is We Buy Cars another Capitec story? These shares keep rallying. I bought at 45 Rand today. Was this a good buy to hold long term for 5 years? Yeah, let's actually talk about that. I mean, do you think that it's showing to be in that momentum, that growth momentum, Mark?
Yeah, so certainly, We Buy Cars is another growth story. The idea is that they will continue to take market share in the second-hand car resale business. On top of that, they can add new products like insurance type products. So there's a new product growth story as well. They're adding different segments. So they started out with passenger vehicles. Now they're adding, you've seen leisure vehicles, and I think commercial vehicles is going to be quite a big growth vector for them. So in that respect, it is very similar to Capitec. It does have a lot of growth still that it can capture, and market share that it can capture. The share price has run very, very hard this year, so perhaps there might be a bit of a period of consolidation, but I think the view is making a long-term capital allocation decision, and I think that We Buy Cars over the long term will do well.
I always get scared when I see that chart, because it's just run up and up and up. And yeah, I kind of want a technical analysis, because you wonder if this is the right time where you get into a stock at its peak, or maybe if you should wait for a pullback. Graeme, what's your take there?
Well, I think in answer to the question about whether We Buy Cars is the next Capitec, I think you need to recognize that Capitec had a scalability in the model, which I don't think We Buy Cars has. I think there's like 500,000 new car sales in South Africa, if I remember correctly. So you can grow your market share, and we'll see what happens in the used versus the new market. But the point is, there's a logical cap there. Yes, you can diversify into insurance and find all sorts of things, but the reality is that if that is your model, you kind of capped. Whereas obviously, Capitec didn't stop when they got to 5 million customers. They kept going, and they added new things, and that meant that the model was almost exponential. So I think there's a difference there. Maybe another similarity, they're both on pretty lofty multiples, particularly on the forward. So, for me, I think We Buy Cars execute very, very well. There's obviously a few startups in inverted commas that are competing with them, and that'll maybe be an irritation, or it might be a significant competitor in due course. But for me, the reality is, I think a company like We Buy Cars is probably also somewhat cyclical. So it's not the kind of business, I believe, that's going to give you 15 or 20% every year for the next 5 or 10 years. There will be years where, courtesy of high interest rates or disposable income pressure, or maybe disruption from Chinese brands, where suddenly you find that the new market looks a bit more compelling than the used market, and maybe they go into a little bit of a correction. Doesn't mean there's anything wrong with the business model. It just means that they are ultimately quite exposed to that. So I think they're very, very different businesses, and I wouldn't say that a business like We Buy Cars, although very, very good operators, is personally, I don't think is worthy of the kind of rating that it's on. So I think, like you and when I look at this thing, I think anybody who looks down is going to suffer from vertigo. So I would sit it out. On fundamentals, it looks expensive, and my point is that I think that the model, until it sort of morphs into more almost silos or foundation points holding the business together, is looking a little bit stretched.
All right. The viewer's asking about the code for Boxer. If I'm not incorrect, it's BOX Box. And you will only be able to find it on Thursday. All right, let's move on to Supergroup. Wait, what is... So, of course, we know that Supergroup, there's that deal that we saw yesterday, or potential deal that we saw yesterday. So this is on that. It goes. Pacific Equity Partners has made an offer to buy not shares of Supergroup, right, but the shares of SG Fleet, which is a business that Supergroup has a majority stake in, for 3.50 Aussie dollars. If the deal goes through, can we see the share rally around 41 Rand a share? So we did, of course, see a big rally there. 19%. Also continued the rally today, up 2%. It's at 27 Rand. Mark, do you think that we could see it go up to those levels?
Well, yeah, it's interesting. I mean, so this is not something that we were expecting. A private equity business buying out SG Fleet from Supergroup. I guess the question is, what are they going to do with the cash that they receive? And also, we're not sure exactly on what kind of capital gains tax that might be payable on the deal. But it is interesting. I think I'd be surprised if, I mean, the share price could rally a bit further, but the problem you have now when these deals get announced is you almost have a bit of a cap to your upside in the shorter term. So really, I mean, once the deal's announced, and then we need some management clarity on what they're going to do with the cash. Are they going to reinvest it? Where? Are they going to pay out a special dividend, which I think will probably be welcomed by the market, but then you've got other issues that now your market cap is going to be a lot smaller. So there's quite a few things to consider. I don't think it's just a case of buy because you're expecting a better offer to come, or expecting a pop in the share price. I mean, the share price already rallied 20% on the announcement, and so now we need more details, especially for us to make an investment decision.
Yeah, all right. I actually want to come to you, Graeme, so that we don't waste a lot of time on another counter that has investors trading on it because of a potential deal at MultiChoice. View on MultiChoice is the share price totally supported by Canal at this point, but without this deal, how do you view the company, Graeme?
Fairly dimly, quite honestly. I think MultiChoice is worth a lot more to Canal Plus than it is to shareholders on the JSE, because I think Canal Plus can introduce things, maybe make them a bit more competitive with the likes of Netflix. We saw the subscriber numbers, etc., from MultiChoice the other day, and they look pretty grim. So I think, unfortunately, the likes of Amazon Prime and Disney Plus and Netflix, and you could probably get all three of those for less than you would pay for your premium bouquet on DSTV. So I think MultiChoice, if I was a MultiChoice shareholder, I would personally have bailed some time ago. If I was a MultiChoice shareholder, I think you want to pray for that deal to happen, because I don't think MultiChoice is a great story as it stands by itself, because I think the competitive landscape will continue to eat away at subscriber numbers, making it increasingly difficult for them to bid for content. So yeah, I'm not a fan of the model. I think subscription TV businesses, particularly those that, I mean, MultiChoice is a big business on the African continent, but in the global sense, relatively small. So I think there's going to be more and more consolidation here. And owning the content is almost more important than anything else. So, no, I'm not mad about MultiChoice, and I think as a shareholder, you really want this deal to happen.
I mean, I guess that's the question. You really want it to happen, but what if it does not happen, Mark? I mean, MultiChoice still does have, kind of I guess, an upper hand in terms of its footprint in Africa and also the investments that maybe it's making into Showmax. I don't know. Would you also be as grim on MultiChoice without Canal, or maybe would you be seeing some upside?
No, I agree with Graeme. I think that I think if the deal falls away, the MultiChoice share price is going to go down quite a bit. So yeah, so if you're a current shareholder, you really want the deal to happen. I mean, we don't own MultiChoice. We're also quite negative on their outlook.
All right. Well, let's get into Absa before your stock picks. Please give your view on the bank, and can the share rally to 200 this year? It looks like this share is really undervalued compared to the other banks. Is it a buy? A lot of people have been saying that it is a buy, and particularly for this reason that it looks undervalued compared to the other banks. Graeme, would you be in agreement?
No, that is my stock pick, so why don't we...
Wait, hold your thought. Mark, let's go to you. Absa at this point, and also if, how much upside if it could go to 200 a share this year?
Yeah, so I mean, I've also picked Absa as my stock pick this year and quite recently as well. And we saw the first rand trading or updates come out today. And one of the key things that they said in their update is that the credit loss trend is improving, that the credit loss ratio has peaked and it is slightly ahead of their expectation even. And on that news, we saw Absa's share price up 2% today. So that has been the main reason why Absa's underperformed, is this worry that their credit losses are going to be sustainably higher for longer. And I mean, it's the cheapest of it's the cheapest of all the banks on the JSE, and I think that their business, I think they do have a really solid foundation to build off of. I mean, they just need to sort out their management structure, and hopefully we'll see some positive announcements in that respect soon.
Okay. Well, Graeme, over to you. Your stock pick. What green lights are you seeing there with Absa?
In Absa, I think everything Mark said, but I mean, in answer to the question, can we see 200 rand in this year? Of course, we're running out of 2024, but when we say it's cheap, for context, at the half year they delivered, I think it was 12.25, somewhere around there. So let's say they're on track to deliver 25 bucks, which is I think what the market's calling. If you put 25 on a 10 multiple, which is not demanding, you're at 250. So I don't know about 200 in this year, but I think it deserves to, when the dust settles, rates normalize, and I say normalize, come off maybe a little bit faster than they have. I think the provisions will definitely reverse, and there's been some turmoil in management, but a business like that's an incredible franchise. So I think the forecast to December is for 14 rands worth of dividends. You divide 14 by 170, it's like an 8% dividend yield. So you're being compensated very, very well. And it's just, for me, relative to the other banks, and remembering if rates go lower and the environment improves, it's going to lift all of the boats in the harbor. But the reality is, because they're at such a big discount to the market, there's a lot more, I believe, performance potential in Absa relative, particularly, say, to First Rand. So I think the credit cycle, and they even said so in the half year, the retail portfolio was looking better. So I think it's one of those where asymmetrically the risks are so much in your favor on the upside than on the downside if you took a 2 or 3 year view. To me, it's just a no-brainer.
All right. Well, Boxer is your stock pick. Mark, your reasons?
Yeah, so I think that, look, I mean, we haven't had a new IPO on the JSE for a while. I think there's a lot of excitement around the business. It is a discount retail business. They've got 489 stores. They want to double their store footprint, so they can add 60 stores a year for the next 5 years. So I think that the growth story is there. It's a good margin business as well. And the placement was heavily oversubscribed. So there was a lot of more investors, institutional investors that put in for stock that didn't get their full allocation. So they're going to have to buy in the market. Now, the challenge is going to be, what price do you pay? Because on Thursday when it opens, it'll probably open, at 65 Rand a share, which is 20% more than where the institutional investors got their stock. But even at 65 Rand, I still think you can buy a Boxer.
Okay.
It might be a bit of a bumpy ride in over the next 6 months, but I think if you want to hold a stock for 5 years, I think that you will do well if you can get Boxer at 65 Rand or less.
Right. Well, thank you so much for your time and for your analysis today, gents. That is all for tonight's edition of Stock Watch. Thanks to our guest, Graeme Körner from Körner Perspective and Mark du Toit from Oyster Catcher Investments. Up next, The Close. Stay watching.